Ed to me. And I like driving on the highway over 100. That's nice. I like the metric system. It's very simple. And in my world, I mean, the water freezes at 0. And this is how I write color. So, thank you. And without any further ado, I would like to introduce our next speaker. Yeah, sorry, I forgot my notes. So our next speaker well, I like the first line here. It says, Brad helps you increase the value of your largest asset, your business. That's kind of a big statement here. So no pressure, Brad, but that's a big statement here. And I also like the last part of the paragraph here, which is where should your company invest right now? That's also pretty good. So Brad has he's coming from a collision business family, but he has an MBA from University of Irvine in South California, where he graduated the top 10% of his class. So that's good guy. He also has an undergraduate degree in international economics, and he's an instructor of financial analysis at Irvine University. So in his downtime, he enjoys drinking coffee, watching Bloomberg TV. I wouldn't have expected anything less with as all this economic background, and that's what I was expecting. So Brad Mewes, welcome to the show. Come on in.
Thank you. Thank you. Good morning. I'm very excited to be here, and thanks for that introduction. So, my name's Brad, last name Mewes. For those of you who are looking at my name saying that doesn't make sense, it's actually a German last name. I speak no German, never been to Germany, but somehow we kept the pronunciation of Mewes over the years. So, today we're going to talk about growth, and we're going to talk about growth in really what I term the automotive aftermarket, but in particular the collision repair sector of the aftermarket. And really about some of the structural changes that have been going on in the industry for over the past couple of years, and the introduction of what I call professional investment, professional capital in the industry, and really how that's changing the industry, and how some of these investors look at the industry and comparing that to how some of us who grew up in the industry look at it. So why am I here? Who am I? Well, as we mentioned, I have a MBA in finance from the University of California, Irvine. I have a bachelor's in international economics from George Washington University, with experience in management consulting, equity research, investment banking. As mentioned, I'm also an instructor of financial analysis at UC Irvine. So looking in the room, looking at some of the faces, that's probably, I gave you a list of reasons why you probably don't want to listen to me, rather than listen to me. But I also have something that I think gives me a very unique insight and perspective on this industry, which is I've literally been doing this since I've been in my diapers. I grew up in a shop. My father owns a shop. I worked for my father, frankly, more years than I care to admit, as is not uncommon in this industry. And, just in case you think this was just something I Googled offline, and that's a cute picture, thanks for putting that up there, you'll notice that this is my father, 35 plus years ago, and you'll notice that the apple does not fall far from the tree when you look at our profiles. So, literally been doing this, I could say that this has been in my blood. And so, what do? So I worked for my father for a number of years, got an MBA, and then eventually found myself back in the industry, but just in a very different capacity. So I own an advisory company. We basically do two things. We do transactions, which means we help you buy other companies, and we help you sell your company. And then we do consulting. And that's the fun stuff. That's where we get to put all this stuff together into a larger package. Help you build a growth and development plan. Help you see what's going on from a structural perspective in the industry. We work with different groups to provide insights in the industry. So financial benchmarking, valuation, some of that longer term strategic planning. So, but enough about me. You didn't really come here to hear me talk about myself. So we're going to be talking about three things. Some of you who may have seen me present before will notice some of the slides in here. I'm taking what I normally talk about over 60 minutes and condensing it into 15 minutes, and then I'm going to shut up. And I'm actually going to invite a panel of speakers up here so that we can hear from their own words what they see going on in the industry. So we're going to talk about the state of the industry, what's been going on in the past couple of years. Very briefly talk about the role of private equity and professional money entering the industry and how that's changed the industry. And then we're going to have a panel discussion. Any questions? Great. So who here has owned, operated, or been in a shop that looks like this? I should see a lot more hands. Come on, don't be shy. And the reality is that this is what the shop of the future looked like 35 years ago. And if you look closely, this was actually an advanced shop. If you look closely, there's a 4-post lift. There's a hydraulic post to do structural repairs on this car. And my favorite part, there's actually a ladder to climb up and get on the car. That's fantastic. So that was the standard 30 years ago. Fast forward to today, courtesy of our friends at Fix Auto, this is the shop of today. And if you look at this shop, and you look at the equipment, and you look at the training, and you look at the investment required to operate a shop like this, that's a radically different business model than the shop we just looked at before. And as the industry has changed, as it's become more technologically advanced, as it's become more capital intensive and training and human resource intensive, the industry's changed. And it's one of the reasons why within 10 years, 2/3 of the revenues of the industry will be captured by the 4 consolidators or the successors that emerge. Now, the guy who said this is a guy by the name of Rex Green. He's a managing director at an investment bank in Boston called Jefferies, and he's very involved in the aftermarket. But he's also very conservative. He's not one who's prone to overstatement. And so he actually went on to say, eventually they'll do virtually all the carrier-paid repairs. And so we've seen in the market, in the US market, in the Canadian market, a high degree of consolidation, a rapid degree of consolidation, really over the past couple of years. And within the Canadian market, obviously, we're all very familiar with the Boyd Group. And in the US market, and then they're publicly listed, and they've been a major player in this market for a number of years. Great success story. I have a ton of respect for what they've done. Within the US, we also have Service King, Caliber, and Abra. And these are the 3 largest, these 3 are all private equity backed, and they operate at this point exclusively in the US. We also have the franchise groups that have played a significant role in the industry as well. I'll get to them in a minute. But I think it's interesting to look at, when I'm looking at an industry, when I'm analyzing an industry, what I do is I like to look at what the leaders of the industry are saying, to get a feel for the direction of the industry, for a feel for what these companies are doing, a feel for what their plans are. And so I figured, I went and did a little bit of research and pulled a couple of quotes down to identify really how are the leaders of these companies who are growing very aggressively and they're investing a lot of money in the industry, and they're seeking outside capital. What are they thinking about? So Steve Grimshaw, the CEO of Caliber. Caliber is the largest collision repair in terms of revenues, really in the world, in North America. He says, I believe there will be more consolidation. Let's face facts. There's a lot of independents out there. Dealerships are struggling. And when you have a well-capitalized multi-shop operation, that creates more opportunity. So we'll talk about that well-capitalized multi-shop operation on the panel in a minute and what that opportunity means. Brock Bullock of Boyd, says, we intend to double the size of our business over the next 5 years. He made this statement about a year and a half ago. And he will. Boyd will double in size, probably in less than 5 years. And he says, the North American collision repair industry remains highly fragmented and offers attractive opportunities for industry leaders to build value through focused consolidation and economies of scale. The company is well positioned to take advantage of large acquisition opportunities. And they did. Anybody heard of the Assured Group in this room? Yeah, one of the largest acquisitions ever recorded in the collision repair industry. And they're ready to do more. Dwayne Rouse, the former CEO of Abra, says the industry has been fragmented in an overcapacity situation. Since the industry itself isn't growing quickly, the better operators are taking market share. And Kathy Bonner, chairwoman really, of Service King, says the trend is for consolidation, but the question is who will be the successful consolidator. So there's been this trend towards consolidation in the industry. And it's become more and more difficult for independents to operate in that environment. And we've seen this take place in Canada for a number of years now. And we've seen significant growth of the franchise model and the banner model in this market, and an increasing significance of the franchise model in the US. Now, we have CSN, we have Fix, we have CARSTAR, all who have grown very aggressively alongside the consolidators as well. Slightly different business model, and we'll have a chance to discuss that a bit on the panel as well, and some of the benefits that the franchise model offers to compete against the privately held, private equity-backed consolidators. And so just a couple of data points to give you a bit of context before the panel comes up here. In 2012, collectively, these organizations accounted for a little over 400, about 500 locations collectively across North America. Fast forward to the third quarter of 2017, and even to today, collectively, these groups account for about 1,800 plus locations. Massive, massive, massive growth. And it's a testament to how effectively these organizations have identified, acquired, and integrated, which I think is probably the hardest part of the entire process, integrated these independent repair shops across North America. And so we're going to talk a lot about acquisitions, and when we have this panel, we're probably going to talk, there's probably going to be some, what I call business school lingo thrown about, and so if we start talking and we start using terms that make no sense, by all means, say, hey, what the heck are you talking about? So I thought it'd be interesting to define the word acquisition, because we hear about it all the time. But the word acquisition, I think this does a great job of describing it. For those in your back who can't read it, it says, acquisition is the discovery that you're no longer a big fish in a small pond, or even a small fish in a big pond, but a small fish in a big fish. And for those that I hear a couple of chuckles, for those of you who have been acquired, I think you could probably testify to that. And so this is similar data points, and I like to be data-driven, and I think this does a good job of illustrating how these companies have grown recently. When you look at 2012, the number of locations collectively these groups added, they added about 100 locations over the course of an entire year. You fast forward to the first quarter in 2016, and in 3 months, these groups added as many locations as they did in an entire year in 2012. Really a testament to their business model. And this is just the same data presented in a different way, really demonstrating that if you're not adding 100 locations a year, you're really falling behind. And you can see when you fast forward and include Boyd's recent acquisition of Assured, where they stack up in recent growth. And it's not just collision repair. It's happening across the automotive aftermarket. It's happening in paint distribution. It's happening in parts. Anybody here heard of a company called LKQ? Massive company that's grown very aggressively as a result of acquisition over the past 10 years. It's done very well for shareholders as a result. And so what's driving that? Well, a lot of it is private equity, a lot of it's public equity, and there's oftentimes a number of misconceptions in the market about what private equity is. And so normally at this point in my presentation, I'll go on and give an explanation of what it is, how it works, and how private equity as an investment class is changing the way that business is done in this industry. But rather than do that, I thought it would be good to invite a panel up here of investors as well as operators who are working for either private equity-backed companies or your investment-backed companies. And so I'd like to welcome my panel up to the stage here. Panel, come on up. We have 4 people who have graciously volunteered to take part in this. I'll let them introduce themselves briefly, but the first is Steve Huntzinger, co-founder and managing partner of Dunham Capital Partners. Steve's a public equity investor and has a number of positions in the automotive aftermarket and is very well versed on this industry. Steve Leal, president, Fixed Automotive Network. Steve's reputation, I'm sure, precedes him. Very well known in this group. The reason Steve is up here is he also has a private equity sponsor with Case Depot and has taken on both an equity and debt position with Case. Next, we have Mike Macaluso, CEO of CARSTAR. As you guys know, CARSTAR is the parent company is Driven Brands, and Driven Brands is owned by a private equity group called Rourke Capital out of the Southeast United States. And so Michael's been part of CARSTAR for a number of years, from before the time it was under Driven to now when it's under Driven and private equity backed. And lastly, we have Jeremy Thompson of Penfund. And Penfund is a private equity firm in Toronto here, and Jeremy's been investing in the automotive aftermarket for 20 plus years now. In fact, Jeremy was involved with OnCap when they acquired Caliber, 15 years, 20 years?
No, it was 2012,
20.
but it was also involved in 97.
In 97.
Created by Oak Hill.
Yeah. So Jeremy's been involved in the aftermarket for a number of years. And so this panel up here is investing. They're putting their money where their mouth is. They see a lot of opportunity in the aftermarket. And so I thought it'd be a good chance for us to really see how professional money is looking at this industry and compare and contrast some of the opportunities between these firms. So thank you all. So let's start with you, Jeremy. You've been personally involved in the aftermarket for decades now. Could you tell us a little bit about what attracted you to the industry all the way back in the beginning? In particular, how you saw Caliber as a attractive investment opportunity?
Sure. I think the first thing I'd say is the size of the industry. In North America, collision repair is about a $40 billion industry. And what private equity firms today are always looking for are the opportunities not just to back the initial investment, but the opportunity to put additional capital into that industry. So the size of the industry is particularly important. I'd say the second thing is the lack of cyclicality. You want to be investing in an industry where it's fairly steady. And the number of cars, we always look at miles driven as kind of a proxy, but if you look at miles driven, you guys all know this, over decades, it generally has grown 1 to 3%. So it's a very steady industry. And that's important because one of the things that private equity are always doing is bringing a lot of leverage to the equation. And you need to have a fairly steady situation if you're going to use a lot of leverage. And I guess the other thing I'd say is that there's a lot of change happening in the industry. It's much more obvious today. It wasn't so obvious 20 years ago, but the insurance companies have really looked to create a better experience for the person bringing the car in to have it repaired, because they've come to realize that that experience will affect how the driver feels about their relationship with their insurance company. And that piece of information really, I think, has changed the way that the whole collision repair experience has happened.
Thank you. And for those of you in the audience, so leverage is what we refer to oftentimes. You know, the translation would just simply be debt, bringing in debt to leverage an acquisition. So when Jeremy says, you know, that we bring a lot of leverage to the table, you know, what that means is that debt is being used to fund the acquisition. So just, you know, a bit of clarity for those of you who may not have picked up on that. Steve, you started your fund about 2 years ago after a long successful career at Citi. Could you tell us a bit about the decision to start your investment fund, how it's structured, and the type of investments you look at?
So I worked at Citi for about 8 years in sales and trading, selling and trading fixed income securities, but always had an interest in investing ever since I was a teenager, and I knew I wanted to eventually start my own fund. So with my business partner, Anthony Olivieri, who's in the audience, we started this fund about 2 years ago, and we started it as an investment vehicle that we basically sunk 100% of our net worth into, that allowed our friends and family to invest alongside us. And thankfully, we've done pretty well, and more than friends and family are now in the fund as well. It's an unconstrained investment strategy, meaning we can invest in anything, anywhere in the world. And the automotive aftermarket is very attractive to us, and I think 25% of our portfolio is in that sector. So we are very constructive on the collision industry for many of the same reasons that Jeremy mentioned. Think it is pretty ripe for consolidation, and given that we can only own publicly traded securities, we're invested in Boyd as a result of that, but think they are obviously doing fantastically well. So.
Steve, in 2015, you decided to partner with Case Depot. And could you tell us a bit about that transaction, what led you to seek outside capital, and a bit how that's structured?
You know, when I was looking at the trends in the United States and the consolidation really with private equity money coming into the groups, for ourselves at Fix, we want to make sure that we had looking for a partner that we can keep control of the company but have a minority stake in the company, give us leverage. So in that situation, we're able to grow and buy companies and have the opportunity. And typical private equity, in a sense for us, it wasn't going to work because private equity typically comes in, you know, takes over, and their horizon is 3 to 5 years looking for return. And I was looking for a long-term strategic partner. Fortunately for us, Fix Auto is a Quebec-based company, and one of the funds that I was after for actually 2 years was the Case Depot placement. It's a unique structure. It's the pension fund of the Quebec people, and one of its charters, it has to help Quebec-based companies grow globally. And the nice part about it is it's against their charter that they can't take more than 30% equity stake inside of the entity. So I'm able to hold 70% of the company and still have a financial backing of a fund. And to give you a size and scope of the fund, the Case Depot right now is roughly just over $300 billion fund. So it gives us unique opportunities. And instead of dealing with traditional private equity, I'm dealing directly with the pension fund. So for example, I could borrow money on long horizons and not pay capital back. So that way I could have 10-year bullets on borrowing money. So that way we're able to fuel growth and not worry about paying back the capital. So it gives us a unique opportunity to look at acquisitions. And for us, also looking for a partner that helps me grow globally. And we use the Case Depot from China to India to Europe, as it has offices around the world, and it's the 10th largest real estate company in the world. So we leverage their resources to help us grow.
And Michael, you've been with CARSTAR for a number of years, and as I mentioned before, it was even part of Driven Brands, and before Work Capital was involved. Could you give us a little of an overview of maybe just your experiences before, when it was still privately held, your experiences, during that transition, and kind of compare and contrast what it's like then versus now.
Absolutely. And back in 1994, when CARSTAR Canada was founded, CARSTAR overall was 1989 out of Kansas City. But in 1994, when Larry Jeffries and Sam Mercani took a risk on an idea that basically didn't exist, they built an incredible company, really a family business of family businesses, franchising in the collision space, which was, along with Fix, kind of revolutionary, right? What we did in 2015 when we sold our organization to Driven Brands was we go by this adage of change before you have to. We didn't have to do that in 2015. We likely didn't have to do it today into 2018. But fast forward a year into 2 years, we saw the changing dynamic in the industry, and you highlighted some of those points, whether it's within distribution, on the paint company side, certainly the insurance company side. There's a tremendous amount of consolidation occurring, big money coming into the space. Those big four players in the US, appear that could pose a significant risk. It does pose a risk for us in the US. So positioning ourselves 2 years ago for the future of the industry, partnering up with Driven Brands has been great. There was our company wasn't perfect before. Our company isn't perfect today. We continually have to improve, but it was the foresight of our team to understand we need to be armed and equipped with the right capital, the right partnerships, and certainly the right intellect. And the beauty of being a part of a company like Driven Brands, it's a portfolio organization where we can leverage across the entire value chain within the automotive aftermarket, whether it's the oil change industry, whether it's the retail paint industry, whether it's on the service side of things. So that's been an advantage that we're certainly starting to leverage in our U.S. business. This year we'll begin to continually leverage up here, but it's the either fortunate or unfortunate, whatever your perspective is, natural progression of this industry. Even just look a couple days ago where Care Foods announced they purchased the keg. Consolidation's happening across every industry, particularly here in Canada. Even I was reading an article in the cannabis industry, which is a hot topic up here, and consolidation's happening based on hype more than anything. So it's something we have to come to grips with. Change is never ideal, but with change comes challenge and opportunity, and we're focused on that opportunity.
So, Jeremy, maybe you could talk, Steve talked about a bit, just to touch on the structure of investment, that case only takes 30% of the equity of a company based off their charter. Could you talk a little bit about how Penfund invests and where they play on the, the capital structure and what type of investments you generally look for?
Sure. So my prior two firms, Oak Hill and OnCap, we really were in that situation like Rourke, where we're partnering with management, but we were taking control of the overall business. So we would be 70% versus 30%. The current firm I'm with, Penfund, we're actually a lender first, but we can put up to about a quarter of our fund in equity. So now we're much more involved in providing the leverage to someone like OMERS or Blackstone or Carlyle, the other players that are the big private equity firms behind these investments. We'll be providing part of the leverage and then co-investing alongside them in the equity.
So generally speaking, I want to kind of open this up to just an open conversation. So I want to talk about some of the trends that we're seeing in the industry and really how you see those trends from a business perspective. And so I'm just going to ask a couple of questions. Each one of you, I'm not going to direct it to any one person, because I want to see just the interplay of the thoughts on that. So, one of the hot topics in the industry right now is technology, automated driver assistance program, or ADAS. Jeremy, you mentioned that you really see a lot of change going on in the automotive aftermarket at present. It's a lot more obvious now than it was 20 years ago. From an investor standpoint, how do you guys see these technological changes impacting the industry?
I can start with that. So the most recent study that I've read was that I can't speak towards the frequency reduction from the ADAS technology yet. We are working on that, given that Toyota and Nissan has made ADAS technology pretty standard, actually standard on all of their lines. It gives us a very valid sample set to study the frequency reduction as a result of that in 2018, say, versus 2017 or 2016. In terms of the increase in severity from this, read a study from Mitchell, and that severity increased 23% as a result of the ADAS technology. So if you are a collision shop operator who has invested heavily in technology and being able to deal with repairing these technologies when they get collided into or break down, that's obviously a huge opportunity for you. So in the short to intermediate term, I'm very constructive on it.
I would just add, I have to defend within our investment committees, there are always questions about these, the technology in the industry. Are there going to be driverless cars? They're never going to crash. And I drive a 20-year-old car, and I always joke that, well, I'm going to be able to cut everybody off because no one's going to be able to hit me. I'm still going to be out there. And I think I look at it as the $40 billion industry. In 5-10 years, it's still going to be at least a $40 billion industry. As alluded to, the severity goes up. All those sensors, all those fancy headlights, they cost a lot of money. So the dollars per repair, I think, are going up. And the frequency, yes, it may go down. I think the automatic braking is something to worry about. I think that is something that'll have a bigger effect than any of the other technology aspects that are out there. But it's a long way away. It'll take a long time to penetrate the 250 million vehicles that are on the road. So generally speaking, I think in the investment horizon for most of the people in this room, I don't think it's going to be an issue, but it's certainly a topic that you always have to talk about.
I agree completely. I have a little bit of a different twist. Yeah, I certainly do feel, and a lot of the data is pointing to more of a longer term time to have significant change within the vehicles out there. However, today we're facing a tremendous amount of pressure. So that headlight that cost $200 3 years ago, today costs $1,200. What we're trying to avoid, and I know our strong competitors are doing the same thing, is that the shop doesn't get pressured or squeezed. At the end of the day, some of the realities today are we have to balance that OEM expectation, safety, the pressures of performance, our profitability. So we're trying to position ourselves, and it's very difficult, but so that we're not stuck in the middle as shop owners, because as all this evolution happens, our partners, the insurance companies, they have premium pressures. They can't just go raise the rates. So we need to fully respect and understand that, as long as when we're in the middle, the ones actually fixing the vehicle, we have to be in the best position to do it right, with the right quality, working with our insurance partners, of course, to have the right price. But there's a dangerous equilibrium that could potentially come out of balance, and we can't get squeezed because of technology, basically. So there's opportunity within it, for sure, but there's some stark challenges that we face today.
You know, one of the worries that I have of all this technology happening, the biggest disruptor I feel is going to be the connected car, right? Because it's going to affect between the insurance industry, the first notice of loss, and who owns that data coming back. So the car complexities, that's been happening, you know, generations after generations, coming from a full frame to unibody and stuff. So that's in our industry is going to change, and part prices are increasing, you know, on the situation severity will go up. But the connected car, it to me is the biggest risk, because saying, and who has the right to that data at that point. And there's two platforms that the OEs are looking at, you know, a kind of closed loop or an open loop, right? And if you look at the German armies using the open loop system, you know, and I think it's scary right now till regulators really control this, to making sure it's a fair balance, that anyone has a right to repair the car, right for the information, versus a controlled environment from the OEs kind of trying to hold that data. So for me, on the technology front, that's the biggest scare for me until that clears itself up. I think that's the biggest threat to the industry.
Yeah, very good points. Can we talk? You know, I'd like to talk about CapEx for a moment, and the idea of reinvesting in the business. Yeah, as technology changed, you know, for a number of years, especially within the collision repair, but you know, really across the aftermarket, there wasn't a big need for reinvestment in the business. And I think of my father and his shop, and he founded the shop in 1982, and he invested continually, but you know, there was a certain point where he had bought all the equipment he needed, he had done all the training he needed, and he just kind of stopped because he'd reached the plateau. There was really nothing more to buy, nothing more to learn. And in the past couple of years, the technology around vehicle repairs has changed a bit, and so really requiring a reinvestment back into the industry. And I think some owners have embraced that and have taken the forefront on it and have been very aggressive investing in new technologies and new equipment. And some owners have taken very much a wait-and-see attitude. I've even heard skepticism. Oh, we've been through all this before. You know, we had the third brake light in the 80s, and we had anti-lock brakes, and you know, I'm not going to worry about this, so I have to do that. So, you know, from an investment perspective, from a company value perspective, could you guys talk just about the importance, you know, how you see CapEx and how you see reinvestment, and why a business owner, you know, how they might want to think about that?
I can start on that. I think early on, one of the attractions of the industry was that CapEx on an annual basis was quite low. So you referenced your father's shop. Once you've outfitted it, there wasn't a lot you needed to spend every year. So when you looked at all of the various costs to running a business, the ongoing capital was low, and that obviously produces more free cash flow, which is what investors like myself always focus on. I think today, with the advent of technology, in particular vehicles with aluminum as an example, that really does benefit the bigger shops. So the multi-shop operator can make a decision across, let's say they own 20 stores or 20 shops in Toronto, they can decide to put it in one and not all. And that again, I think anytime more technology, more capital comes to an industry, it benefits the large because they can make those types of decisions.
And that's what keeps it ripe for consolidation. Traditionally, as from my studies, the capital expenditure, which is the cost that you have to sink back into your business to keep it afloat, has been about 0.8% of your sales. So to avoid confusion, if you do $1 million of sales per year, $8,000 is about what you have to reinvest per year to keep your shop afloat, traditionally. But because of this new technology that Jeremy's speaking about, he's absolutely right. And you know, if you have to make a huge investment in aluminum technology that might cost you $1.5 to $2 million, but you can spread that across 10 shops because you only did it in one shop, that's what makes this industry ripe for, that's one of the factors that makes this industry ripe for consolidation. And it makes it a little bit more difficult if you're just operating a single shop, in my opinion.
And I think the difference, particularly in the two markets, US and Canada, that 0.8% with Abra, Service King, whatever, of $1 billion, it's a lot of money. 0.8% of a couple stores in Toronto doing $2 million can't really compete. So that's the stark reality that we face, and where I agree with my colleagues on the panel too. The challenge becomes when we're told, or if we're told, you need the same piece of equipment by two different manufacturers, wherever the case may be, to do the same thing. And then you get into waste, you get into redundancy, it's taking up space in the shop. It's those kinds of things need to be sorted out a lot sooner for the sake and the benefit of our industry, for sure.
You know, the one thing I like about the change that is forcing people to make a decision, right? So if you want to stay in the business, either you sell it or you join the system. I think it's getting individual shop owners that they need to actually do something, right? So for me, in the CapEx situation and the change in industry is forcing people that they need to line or sell or do something, right? So it's kind of forcing the situation for consolidation. So I look at it as a positive as much as a negative. For our business, selfishly, I think it's forcing people that really have to look at their business. How am I going to survive? What are the tools and resources I need to keep moving forward?
Yeah. You know, sometimes when I'm at industry events, I'll hear a misconception. You know, I'll hear somebody say, "Oh, well, you know, these big companies, you know," and maybe they're referring to, you know, franchise groups, consolidators. But you know, I'll hear misconceptions. You know, these big companies, they're operating at a loss. They're losing money. They're just spending their investors' money. Could you guys maybe talk a bit about, you know, maybe Jeremy, you could take this, you know, about when a private equity firm makes an investment in a company, what that cash is used for, and you know, really how that flows through the business, and maybe highlight, you know, the fallacy of that logic.
I think the fallacy that you're referring to is when people look at the income on a financial statement, and that might be at a loss. And that really comes about just because of how a lot of these businesses are capitalized. And so I think the The term in private equity is often EBITDA. I really hate the term because it doesn't recognize capital and it's just a term. But if you really just look at free cash flow, of what cash does a business generate, that's the most important metric. And then how you leverage, how much debt you put on the business or what tax rate you pay is the implication that spits out what your bottom line net income is. And a lot of these big players are just putting so much debt on the business that you as an individual operator would never do. But if you're a $10 billion fund and you can borrow money at cheap rates and leverage the business that way, you're going to do it. And if the tax rules allow you to now fully depreciate the equipment in the first year, well, you're going to do it. And that's going to have the effect of reducing the net income. But they're not, for those large $10 billion funds, they can always put more money in. They have more capital behind it. And that's not something that an individual operator has. So hopefully I'm answering your question, but I think that's the misconstruction of how your individual statement would look relative to one of these big guys.
Yeah, and there's the idea, and I talk with business owners about this a lot, which is accrual versus cash-based accounting, and especially as we get lower in working with some of the smaller businesses, there often isn't. The accounting is a blend of both, especially for tax reasons. Most business owners that I'm working with are thinking cash-based, yet there's still some accruals on the P&L as well, and it does create quite a bit of confusion at times. At what point, and Steve, maybe you could start with this one. At what point does it make sense to start looking for outside capital? And maybe you could talk about your experience a bit. You saw what was going on in the U.S., but for the members in the room who are of a certain size and they're growing, in your experience, when did it make sense to start looking for outside capital?
So for us, it's trying to prepare ourselves. When I was looking at it, we don't have billions of dollars sitting, in our war chest ready to take a season opportunity. So I needed to have a partner that had the capital that if an opportunity came, like we've been doing over the last 2 years, is trying to diversify our business for our stores, is from the collision business to the mechanical business to the glass business. So you've seen us acquire some companies over the years, and access to that capital. When you have a private equity fund, like you said, is they're able to have the confidence from the banking system to borrow money into those institutions a lot easier than Steve, Leal could myself, right? So you needed to have a partner. So if you want to grow on the banking system and borrowing money, you need to have a partner involved with you to have access to that capital that they'll let you leverage the business on your EBITDA, on terms of senior debt, and have opportunities for sub debt, so you can seize on those opportunities to grow. So if your business is stagnant, and at that point that traditional banking systems, typically in the body shop business, they weren't favorable to the body shop. So if I go to a bank and want to borrow money from my body shop, it's very hard to get access to the funds from traditional banking systems. So knowing that and trying to help our franchise partners, I brought on a partner that if I now can leverage myself with the franchisee, if he wants to grow, we'll give him access to capital to grow. So in our system, trying to get access even for our stores and our franchise partners to have access to that funding, traditionally that never was there. So if, no banking system would really touch us, where environmental hazards, they didn't want to lend the money, the security risks for them. So for me, I needed to get the partner so the banking system would actually look to us to invest in that point. So for me, it was hurting us from growth that I didn't have the opportunity, and we only had so much amount of capital and access to capital that it was hindering our growth. So I needed to find a situation that could blend what I was looking for to grow and that opportunity, and that's why we found the Case Depot.
In your experience, Jeremy, when does it make sense for the companies you're looking at to start seeking outside capital? What type of companies do you have thresholds? Do you have minimum sizes of companies you look at, minimum sizes of industries?
We certainly do. And I think the size is often dictated by how big your fund is. You can only spend your time on so many different investments. So for us, we tend to look at investments that are somewhere between 20 and 120 million. But I think from an operator's perspective, the real decision is you can probably grow from 1 to 5 or 6 shops and have oversight of that system yourself. And then you face a really fundamental question, which is going to be, am I going to grow bigger, and am I going to invest in the overhead to manage a much bigger establishment, a much larger group of shops? And that's going to cost you because you're going to be putting in a management structure that you didn't previously have. And that'll set you backwards for a little while, but it gives you the ability to then grow. And I think that's the big decision is, am I going to grow to this point and then sell, or am I going to become a larger regional player that will then be attractive to a private equity firm or one of the consolidators? So that's the thing I see a lot, is that decision about whether or not to go to that next level.
And that's a good point. Do I grow to exit, or do I grow to then pursue further growth? And so, maybe for the two investors right here, could you guys maybe talk a bit, at a high level about valuation and for example, why is a 100 chain operation, all things equal, value higher than a 10 chain operation, and kind of the benefits that economies of scale might provide from an investment standpoint?
The economies of scale that you speak of, that allows us to grow faster. It makes insurance companies want to direct more of their business to a place where the processes are more systemized, more programmatic. I've spoken at length to a lot of insurance companies. This is actually, of all the investments we've made, and we have investments across the entire spectrum. For example, we own Facebook as well as Boyd Group, right? I can talk to Facebook's customers more easily than I can talk to Boyd's customers. So I spent a lot of time trying to make contacts, talking to the decision makers at a lot of these big insurance companies. And from their standpoint, they have actuaries who underwrite the insurance policies, and actuaries like predictability. And if you have a programmatic and systematic way that you run your shop, and your cycle times are consistent and your work is consistent, you will get more work than if you're a shop that doesn't have those things. So that made a lot of sense to me when I heard it, but it wasn't something that was intuitive. So maybe that is part of the reason as to why a 50 to 100 shop operator might trade at a higher valuation than a 6 shop operator.
I'd answer it two ways. I think there's relative valuation and then there's absolute valuation. And the relative question is, why is a 10 shop operator worth this multiple and a 100 shop operator worth this multiple? And the reason for that is that the 10 shop operator won't have the economies of scale, which is something you hear a lot, that the 100 shop operator will have. So if you're in one of the consolidators' boardrooms and you're looking at a 10 shop operator that you're going to look at, you're going to say, well, what's the capacity of that shop? How many paint booths does it have? Is it going to be a 300,000 or a 400,000 a month? Can we really take this to a higher level? Because we are going to bring 10 DRP relationships where as soon as we buy that location, we get turned on and we can send more cars to that location. So we'll get more cash flow out of the assets than the 10 shop operator can. And that's why they trade at a higher multiple. On the overall multiples, whether you're in a situation where the 10 shop operator is worth 5 times EBITDA and the large one's worth 10 times, or the smaller one's worth 7 times, the other one's worth 12 times, that just goes to the overall economic values that are out there. And that really has to do with interest rates. And you see where rates have been really, really low. There's lots of capital out there, whether it's in a public context or a private context. And there's a lot of pressure for all those people to put money to work, and that forces values up. So we're in an environment today where those values have gone up and up and up, and they just, every year we think it's going to end, and it's just gone higher.
I think two things come into play, and it's really kind of repeating what everybody said, but it's scalability and continuity. Can you continue to scale on with that 3-store MSO to get to 5 or 6 or double the revenue, wherever the case may be? And when that owner leaves, or if he or she stays, can the performance for our insurance partners continue? So I think that those are two major factors, financials and every adjustments aside, in determining percentage of sales, multiple, whatever the case may be. In our experience, when we make acquisitions or when we work with our MSOs to make acquisitions, it comes down to the scalability and continuity.
The one thing that you want to keep in mind is when you talk about interest rates, as interest rates goes up and these companies are leveraged, the ability for them to pay back in the debt situation, and typically when it gets flipped by private equity a bunch of different times, it's re-leveraged every single time. And if you look at some of the companies in Europe that have already done this, CARE is a classic example. Consolidator of 100 shops, flipped 5 times. By the 5th time holding the bag, the rival bank, it went bankrupt at that point. So when interest rates change on that model, it's a kind of a private equity game. It's who's holding the last the last at the table at that point that leverage that situation. So it's always a risk factor, but you'll see when interest rates come up, valuations come down because the risk factor is becoming more transparent to the end of the cycle, right? In typical private equity, they're turning their money, right? So they need to turn the money 3 to 5 years. And when it gets in that cycle, the risk is when you go through that cycle, if interest rates get up higher, it puts a situation of strain on that company.
Could we talk a little bit about the management structure? And we talked about the idea of are we going to invest in management to scale up? But I'd also like to get the board's, the panel's feedback on, from an investment perspective. Steve, maybe you could start with this. When you took on an investment from Case Depot, what changed? Was there something that maybe in hindsight looking back you would have realized, you would have planned for that caught you off guard? Or perhaps just what changed in terms of reporting, working with an outside sponsor?
I think the biggest change, and I went from owning one shop, obviously, and growing at that point. When you own your one shop, you do your accounting books a different way. And as you grow and getting institutional investors, they don't invest in companies without doing proper due diligence, making sure that the financial metrics at that point make sense. And I think we knew that before we going out looking for a partner. And I think that was the biggest change for us, is really changing in how we report our financials, structuring ourselves in a way that institutional investors will look at it and understand it to the way that they're used to seeing it, versus a traditional, say, body shop owner or small business. It was changing us to the mid-sized business and making sure that the financial structure makes sense for them, and the reporting style for us is no different between us now and a publicly traded company. We're at the same format, right? And I think that was the biggest shift, more on the financial side. But for us, we already knew that going in, so we prepared ourselves before we went out there. So it wasn't a big culture shift for us, right? But I can see a lot of people when they come up to private equity wants to invest, and they look at their financial statements a certain way, different than a typical owner. EBITDA, some guys don't really understand EBITDA. They'll look at their net and saying, I don't understand. You're paying me 10 times on net, right? Versus, maybe 6 times on EBITDA, depends on how they structure it. So the sophistication of these funds coming in is definitely raising the bar for a lot of people to understand on the financial metrics.
Mike, can you maybe comment on just some of the changes back and forth that you saw in terms of maybe management structure, reporting, how information was shared within your company?
Yeah, there was being completely privately held before with a smaller ownership group. We had different, similar to exactly what Steve was saying, just a different way of reporting on a monthly basis or quarterly or so on. Now in the new world, I think it is a little bit more, I don't want to say advanced in terms of it wasn't as advanced in the day, but there's certainly some changes just in the way we report, the metrics we look at, a big focus on margins more than even dollars in that sense. A greater focus even into 2018 as we're building, ensuring our franchise profitability. So we're building an entire unit within Driven Brands to focus and help our franchisees manage their profitability in the right way, which is something we did before, but we didn't do as much. So it's an expansion of the numbers we're looking at internally and also for our partners. I think it was the necessary evolution for our business in just looking at it in a more deeper and thoughtful way, especially because within our portfolio, we have others to compare it to as well, right? To see where we're doing well, where we're doing poorly, what can we leverage. We have a shared service model as well that assists and comes in, which doesn't necessarily directly affect our network, but they help us as a corporate team to properly manage and forecast forward potential risks or issues. So the forecasting piece has also been a significant change for us, where there's a very strong emphasis on forecasting.
So really what I'm hearing from both of you is there was a significant investment made in terms of financial reporting, financial analysis, accounting, when you're privately held and you report to no one, you could probably not have to worry about that investment. So kind of there's this theme of reinvestment. Jeremy, can you maybe talk about how you interface with your portfolio companies and what the expectations are around reporting from the portfolio company back up to the fund level?
Sure, happy to. I think there obviously is a lot of emphasis on financials because that's the nature of what we do. But really financials are looking backwards. It's sort of keeping track of how you did relative to where you thought you were going to go, or trying to recognize issues that need to be fixed. The main thing you're trying to do, though, is your interaction with the management team at a board level is strategy. It's looking forward. And what do we need to do? So that was mentioned earlier in terms of capital expenditures. Okay, how are we going to deal with that? So if we need to have aluminum clean rooms, what are we going to do? And how are we going to handle that? Looking at the trends of what's happening with various vehicle changes and thinking forward. And then using the network and the capital that you have access to be able to be prepared for that. I think that's the main thing. And if you have a outside capital, you have a sounding board, it's a lot less intimidating when you can say, you know what, we've been through this with this CEO, why didn't you speak to him or her? And they'll give you some feedback on what they did.
Yeah, very, very powerful. I think having that board level resource is something that, yeah, and I made a comment on this recently, that so many privately held business owners are responsible to no one. They're responsible to themselves, and having an outside board to either bounce ideas off of or provide insight and clarity on challenging business issues, I think is very, very valuable. We have a couple minutes left. I want to be respectful of time. And so I did want to give members of the audience a chance to ask a question or two. So does anybody, there's a couple microphones out here. If you want to ask a question of the board, just come up and grab the microphone. Lightning round.
I'm not, there it is. I was going to say I'm not tall enough. Okay, great presentation. Thank you. I guess what I'm taking from this discussion is that this is really a call to action for independent and regional shops. If you don't want to be the small fish in the big fish, what do we need to do to continue to thrive, not necessarily grow, because growth and thriving are not necessarily the same thing. So from your perspectives, you've already told us traditionally you needed to spend about 8% of your annual earnings on reinvesting. What are you seeing today? In terms of working with partnerships, what do small independents and regional companies need to do in order to be able to attract additional capital? Does it always have to be from private equity firms? Or there's some other opportunities? So I would like to shift the discussion back a little bit to some of the realities that continue, because even if we do talk about the CARA, and in Manitoba and Saskatchewan, yes, we certainly do have large restaurant chains. But what's unique in our markets is that the small businesses continue to thrive. And so I'd like your perspective on that.
Well, I think, one of the things for me is I'm a big fan of entrepreneurs, right? So I think we wanted to build a model that even if an independent operator would be involved in our system, we give the ability to them to have scale to be able to achieve the same size as these consolidators by contributing into a fund. And if you think about it at that point, is you might not be able to afford to have a national sales rep, but inside the system you're able to afford it by spreading out the cost between many shops. So we're trying to make sure our model follows the entrepreneur. We believe in the entrepreneur spirit, I think, but we want to give the corporate structure of an environment that gives them the ability to compete against the consolidators. Pretty much is our model. I think independents, they have to look at what their strengths and what they're looking for. Specific markets like Saskatchewan, it's government insurance. It's a bit different. It's not as competitive, I would say, in some of the other provinces. But change is inevitable. I always laugh when my mom, when we first brought out the BlackBerry smartphone, and she said I would never have a smartphone in all these years. And finally last year, now she has a smartphone, a Samsung. And I said, see, my mom can change at 67 at that point. So change sometimes takes longer, but I think it's inevitable, even in our industry, that the change is coming, and I think people have to look at their options to growing, stabilize, but eventually, I would say everything comes to a conclusion that it needs to change. And you've seen it in other industries, from Kodak, invented the digital camera and refused to really invested in it and slowly, you know, died away to eventually have to go bankrupt and change. So even the big companies fall victim to this, no different than a small company.
I would agree completely. Being pretty much a full franchised organization, it is the individuals who own their locations. And I read an article a few days ago about franchising, and it said franchising is the new mom and pop, so to speak, right? Where, and not just in collision repair, but across all different segments, whether it's in restaurants or whatever the case may be, because of the vast opportunities, exactly as Steve mentioned. Franchising is a great conduit so that you still own your business, of course. You're in your community, you're invested in the community, you can scale up with the right partner. The one difference in our business is we deal with an institutional customer, so to speak. Definitely it's B2C, but arguably it's B2B as well. So our partners are looking for fewer groups, individuals, people to work with so they can service their customers in a different way. I don't want to say better or worse, in a different way, but I also do think we're fooling ourselves if we think that there won't be any independents left. There'll always be room for strong independents, and those that are in this room, those are the ones that are going to succeed, because they're looking to make the investment of time, energy, and resources, and there'll always be that need complementing strong national players or regional players as well.
I'd agree with that last statement wholeheartedly. I think there will always be room for strong operators. And the danger is if you continue to not look for outside influence to help your business, that to the extent you could get an outside board member to help you with your business, to the extent you can get more training, if you're a good operator, you're always going to do well. That's the scarcity in all the businesses we look at. There's lots of capital. It's always, is someone willing to make the business better and put together a better plan than the next person?
And as part of my research, I've befriended quite a few private shop operators in the U.S. I get actually a lot of information talking to people that own one or two shops, and they actually really enjoy talking about their business from someone who's inquisitive about it, and they don't feel threatened by Boyd, at least in the northeastern. We're from Boston, at least from the northeastern part of the U.S., because a lot of consolidation hasn't started to take place there from the MSOs. So get a lot of information there. We befriended one guy that owns 2 shops in Connecticut, and man, if Boyd only operated in Connecticut in his market, I'd be pretty nervous. And he's an independent operator, and he, is getting OE certified across a number of different brands. He's making investments in aluminum technology, carbon fiber technology, where it's going to affect his financials this year, but for the next 3 years, it's going to be great. He's also not worried about what his margin percentage is as well, right? So a lot of operators like to brag that they have 15% cash flow margins or EBITDA margins. Whereas if you're willing to take an 8% EBITDA margin in exchange for 3 times more revenue, and that's a lot of maybe moving parts at once, but if you're willing to accept a lower margin, you can get a lot more revenue, and then your profit dollars actually go up. So think Costco, think Walmart, think Amazon. If you can introduce that concept to your business a little bit, that'll give you a lot of power as well.
And it kind of goes back to Jeremy. I mean, you talked about, it's really about free cash flow. Ultimately, the evaluation of a business is determined on the cash it generates. And what I like to say is you can't eat margin. You can't go to the grocery store and spend margin, but you can go to the grocery store and spend cash. So I think that's a big part of the business. Any other questions?
Hello, there we go. From a jobber standpoint, as the big get bigger and they can wave a bigger stick at the manufacturers, where do you see the future jobber fitting into these massive nationwide deals? We saw what Boyd decided to do, which was we can take most of this in-house and we basically just need the jobber to be a delivery boy. How long do you think the others are going to take before they follow that, or do they look at that model and say, no, that's not the best use of our margin or our resources? And how long do you think the jobber will stay as we know it, or what do you think they're going to change to?
I can start with that one because I'll tell you, whereas 10 years ago there was a lot of talk about consolidation in the body shop business, and we had a lot of conversations with private equity guys that were getting into that. Now it's about the jobber business. There's a lot of private equity, and as you put up on the slide, there's already a bunch of public players that are consolidating that space. I think you're actually going to see that pick up speed now, just like it has in the body shop business. And it's a tough spot to be because you're right between the consolidation of your customers. And so if you're an independent and you use that jobber and now it becomes part of Gerber or Abra or Service King, then all of a sudden that's going to change because it's going to be somewhat dictated by what their paint relationship is and who the paint supplier says they should use. And then on the paint side, you've had consolidation there and that direct discount structure that they're putting in place. So I think if you're in the middle, you're faced very much with that either grow and put yourself in a position where you're more diversified and you provide more value or whatever moats you can create to protect your business, or you really are going to get squeezed on both ends.
Any other questions? Going once, going twice. All right. Well, I'll wrap it up. Thank you to my panel. Let's give them a round of applause. And just to give a bit of context, what these four gentlemen did up here is quite extraordinary because it's not often that we have an opportunity to hear firsthand from investors, from operators in the business about this topic. This topic tends to be very private. A lot of folks tend to err on the side of caution when talking about finance and strategy in business. And so everybody up here took a bit of a risk to be up here, and I personally thank you for that as well. So I'll be around the rest of the day. Shameless plug, we talked about a lot about boards, financial management, outside perspective. That's a key component of what my firm does. So by all means, please, if you take a look at my website or come to me afterwards, I'd be happy to chat with you. Thank you.
Okay. Well, I was trying to make notes, but at some time I got lost in the magnitude and the size and all the things. But one common theme is definitely the change piece. So before we go to a break, I think we need to hear the music here and use our little clickers. Okay. So we're going to take a short break. We would appreciate if we can start at 10:30. So please enjoy the meeting area, enjoy the booth, network, and we'll start at 10:30 to talk about some pre and post scanning.